If you've ever wondered why some Forex traders seem to catch huge moves while others barely see any action, it usually comes down to one thing: volatility. Volatility is what creates opportunity in the market. The bigger the price swings, the bigger the potential profit, but also the bigger the risk. So today we're looking at the top 3 most volatile currency pairs that traders love to watch. First up is GBP/JPY, often called the Dragon. This pair is famous for its massive price swings. It combines the British pound, which is already one of the more volatile major currencies, with the Japanese yen, which is heavily influenced by global risk sentiment. When markets become uncertain, or when big news hits the UK or Japan, GBP/JPY can move incredibly fast. It's not unusual to see this pair move over 100 pips in a short period of time. Because of that, many traders love it for intraday trading and scalping. But with that volatility, you really need solid risk management. A lot of traders rely on tools that automatically manage stop losses, break-even levels, and trailing stops, so they're not scrambling to adjust trades while the market is moving quickly. Next is GBP/USD, one of the most traded pairs in the world and another highly volatile one. It's often called cable, and it reacts strongly to economic data from both the UK and the United States. Interest rate decisions, inflation reports, and employment data can send this pair flying. Because both currencies represent major global economies, the liquidity is extremely high, which means sharp movements can happen quickly when new information hits the market. Many traders like GBP/USD because it provides frequent trading opportunities while still being relatively easy to analyze with technical tools. Some traders also use automated systems that scan the market and highlight high-probability trade setups, especially during major sessions like London and New York when volatility tends to spike. The third pair on the list is XAUUSD's close cousin in terms of movement style, but in the currency world that role is often taken by GBP/AUD. This pair is known for some of the most aggressive moves among major Forex pairs. The reason is that it combines two currencies influenced by very different economic drivers. The British pound reacts heavily to UK economic policy, while the Australian dollar is strongly tied to commodities and global trade demand. When those forces move in opposite directions, GBP/AUD can produce huge trends and powerful breakouts. That's why many experienced traders watch it closely, especially during periods of strong market momentum. The key thing to remember with volatile pairs is that while the profit potential is bigger, discipline becomes even more important. Fast-moving markets can easily trigger emotional decisions if you're not prepared. That's why many traders use trading dashboards or automation tools to help manage positions, track signals, and control risk while the market is moving quickly. Some platforms even use machine learning algorithms to scan multiple pairs at once and identify strong trends or high probability setups, which can be incredibly helpful when trading volatile instruments. At the end of the day, volatility is what makes Forex exciting. Pairs like GBP/JPY, GBP/USD, and GBP/AUD offer huge opportunities for traders who know how to manage risk and stay disciplined. If you learn how these pairs behave and combine that knowledge with good trade management, you can take advantage of the big moves that many traders are constantly looking for.